Hello and welcome to our Chapter 1 video lectures annotated. So basically what I will do is I will be covering in several shorter lectures the major learning concepts for Chapter 1. As you saw in our course navigation video, I have all of the PowerPoints loaded for you in D2L, and what these video lectures are supposed to be is basically highlighting the points that I would like for you to emphasize. I expect you to fully read the chapter and, more importantly, fully read the PowerPoints as well, and by completing your homework and your quizzes, I believe you will definitely be more than ready for the exam. So let's start with our first chapter, the environment and theoretical structure of financial accounting. And I will not be going over all of the slides, but I'll be going over the ones that I really want to emphasize for you. So first, financial accounting is basically accounting for external users, mostly investors and creditors being the predominant two, investors and creditors serving as banks. And the main mode in which we communicate the language of accounting is our financial statement with the balance sheet, income statement, statement of cash flows, and statement of stockholders' equity. So each financial statement has an equation that's quite important. Assets equals liability plus owner's equity, or LO, as I like to refer to it, is our accounting equation. It is pivotal. Debits equal credits. And that's pretty much our preface of accounting. In our income statement, revenues minus expenses equals our net income. And then in our statement of cash flow, that is comprised of three activities: operating, investing, and financing. And then in our statement of cash flows, we have our beginning balance plus our net income, as you can see from our income statement, less our dividends equals our ending balance. Now remember, dividends are a contra equity account, so they do not equal expenses. That is a common mistake that students make. Financial reporting is the process in which we provide the four financial statements: the balance sheet, the income statement, the statement of cash flows, and the statement of stockholders' equity. Cash basis accounting is not GAAP. So cash basis accounting does not equal GAAP. That is where we record cash when it is received. So we have cash receipts and cash payments. When customers pay you through the accounts receivable process, that's when you record it. When you make payments through the accounts payable process, everything is recorded at the time that cash is released. So if cash is received, you record it. Cash receipts, cash disbursements, or payments when you pay it. Now, accrual basis of accounting, that is GAAP. GAAP is generally accepted accounting principles, and we'll talk more about that in another lecture. But that is where we're measuring the revenues and expenses. We don't care when they were received. GAAP used to provide that revenues were recorded when earned and expenses when incurred. But you will note as we progress through our discussion of GAAP that this has changed a bit. Not major, but there have been some modifications. So here we have an example of cash-based accounting. And cash-based accounting, whether you prepay rent for 3 years, you would record it all in the period in which you paid it. So this was your cash disbursements or your accounts payable in year one. And then your net operating cash flow is affected by that, obviously, when you make the payment. Accrual accounting, which is GAAP, generally accepted accounting principles, we see then that that prepayment is actually dispersed over the 3 years, as you can see here. So you have $20,000 in each of the years, and it's highlighted for you to show that you are actually accruing the cash, and whether you've paid it or not is irrelevant. So that's the end of this lesson. Hopefully you've learned a little bit about cash and accrual and the four financial